A stock price can change by 5% in a single afternoon, and no law was broken, no product failed, no factory burned down. That movement was built on expectations, not reality. And expectations live in the minds of millions of people who never meet, never speak, yet move in waves as if by the end, you will see the one mechanism that quietly changes everything. Let's begin with a question that sounds simple, but reveals an entire hidden world. Why does a piece of paper, or a number on a screen, gain or lose value when nothing physical has changed? The answer lies in a system that runs on trust, information, and the eternal tension between fear and greed. Imagine a marketplace in Amsterdam in the year 1602. Merchants gather to trade shares in a new company, the Dutch East India Company, the first publicly traded corporation in history. A share is a claim on future profits from voyages that have not yet returned. Cargoes not yet sold, ships still at sea. The price of that share moves every day, sometimes every hour, and it moves for one reason. People change their minds about what the future holds. This is the first framework, the expectation engine, and it has 3 gears: future earnings, collective belief, and new information. When any gear turns, the price moves. A rumor spreads that a fleet has been lost to pirates. Share prices fall. A captain returns with spices worth 10 times the voyage cost. Prices rise. Nothing about the company's assets has changed in that instant. Only the story people tell themselves about what comes next. If you found value in what the economic archive is uncovering here, tap the like button and subscribe so you don't miss the mechanisms that shape our world. Now let's move forward in time to understand why these patterns repeat. By the 1700s, stock markets existed in London, Paris, and across Europe. Prices swung wildly, and observers noticed something strange. Stocks often moved together, even when the companies had nothing in common. A bank, a mining venture, a shipping firm, all rising or falling in sync. This was the second framework, the mood contagion model, and it contains 3 forces: social proof, emotional momentum, and liquidity flow. When one stock rises, investors feel optimistic, and that optimism spreads like a shift in weather. People buy not because they analyze 10 companies, but because they see others buying and fear being left behind. Liquidity, the pool of available money, floods into markets when confidence is high and drains when fear takes hold. The result is a cycle that has repeated for centuries: calm, enthusiasm, euphoria, doubt, panic, despair, and then calm again. The cycle does not require corruption or manipulation. It requires only human beings making decisions under uncertainty. But that was only the beginning. In 1929, stock prices in the United States had climbed for years. Companies were profitable. The economy was growing, and millions of people, many investing for the first time, believed prices would rise forever. Then, in October, the market collapsed. Within weeks, billions of dollars in value vanished. What changed? The companies still owned factories, still had customers, still produced goods. The answer is that price is not the same as value. Price is what someone will pay right now. Value is the sum of all future cash a business will generate, discounted back to today. When belief in that future collapses, price follows, and it can fall faster than it rose, because fear moves quicker than greed. This introduces the third framework, the value versus price gap, with 3 components: intrinsic worth, market sentiment, and time horizon. Intrinsic worth is what a rational, patient investor might calculate by estimating earnings, growth, and risk. Market sentiment is the emotional temperature of the crowd. Time horizon is how long you can wait. If you need to sell tomorrow, price is all that matters. If you can wait 10 years, value may win. The gap between these two numbers is where fortunes are made and lost. Few people realized what changed next. After the 1929 crash, regulators introduced new rules. Companies had to disclose financial information. Insider trading was restricted, and markets were monitored. These changes reduced some risks, but they did not eliminate the cycle, because the cycle is built into human psychology. Fast forward to the year 1999. The internet was transforming communication, commerce, and culture. Investors poured money into technology companies, many of which had no profits, no clear business model, and in some cases, no revenue at all. Stock prices soared anyway, because the story was irresistible. The future was being built, and early investors would be rewarded. Then the bubble burst. Trillions of dollars evaporated. Once again, nothing fundamental had changed overnight. The internet still worked. The technology still existed. What collapsed was the collective belief that prices could keep rising without earnings to support them. History does not collapse overnight. It erodes quietly. Let's zoom in on a single day to see how prices actually move. Imagine a stock trading at $50. A pension fund in California decides to buy 1 million shares because it needs exposure to that industry. The fund places an order, and suddenly there are more buyers than sellers at $50. To attract sellers, the price ticks up to 50.10, then 50.20. No news has been released. The company has not changed. The price moved because of supply and demand in that moment. Now imagine the opposite. A hedge fund needs cash and sells 2 million shares. The price falls to 49.50, then 49. Other investors see the price falling and assume something is wrong. They sell too. The price drops further. This feedback loop can create crashes that have no connection to a company's actual performance, only to the mechanics of the market itself. This is where the recurring motif returns. The number on the screen. That number is not a fact. It is a consensus, a temporary agreement between strangers, and it can change in seconds. By the 1980s, computers entered trading floors. By the 2000s, algorithms executed millions of trades per second. Speed increased, but the fundamentals remained. Prices move when expectations shift, when information arrives, when emotions tip from hope to fear. In May 2010, the U.S. stock market experienced what is now called the flash crash. In minutes, nearly $1 trillion in value vanished, then reappeared. Investigators later found that a single large sell order, amplified by automated trading systems, triggered a cascade. No scandal, no disaster, just machines reacting to machines. The number on the screen flickered, and for a moment, the illusion of stability cracked. Let's connect this to a modern parallel you can observe right now. Open any financial app and watch a stock price update in real time. Every tick reflects a transaction. Someone decided to buy, someone decided to sell, and they agreed on a price. That price might be based on careful analysis, or it might be based on a headline read 5 seconds earlier, a tip from a friend, or pure panic. The system has not changed. The mechanisms are the same ones that moved prices in Amsterdam in 1602, in New York in 1929, in Silicon Valley in 1999. What has changed is speed, access, and volume. But the engine is still the expectation engine, still driven by belief about the future. Here's the quiet truth beneath it all. Stocks go up when more people believe the future will be better than the present, and they go down when that belief reverses. The company itself may not change for months. The price changes every second. The gap between those two realities is the space where markets live. This decision quietly changed everything. When you understand that price is a story and value is a calculation, you stop asking why a stock moved today and start asking what the crowd believes will happen tomorrow. You see that volatility is not chaos. It is the sound of millions of minds changing in real time. You realize that the market is not a machine that reveals truth. It is a mirror that reflects emotion, information, and incentive, all blurred together. The economic archive exists to decode these mechanisms, to show you the invisible forces that have shaped economies, empires, and everyday life for centuries. If this perspective expanded the way you see the world, subscribe to keep exploring with us. Drop a comment sharing which framework resonated most. Share this with someone who wants to understand how markets really work. And watch the next video where we examine the hidden cost of printing money and why it matters more than almost anyone realizes. The number on the screen will keep moving, but now you know what moves it.